Hello everyone. Well, we're at the end of the second quarter and through the financial year. Time is truly flying. For this quarterly update, I wanted to provide you with a little bit of a background and commentary to accompany our economic update. But this quarter really has been a difficult quarter for households as the effects of the interest rate rises continues to be felt, albeit with some relief from the RBA in May, which we think unfortunately is temporary. Central banks still remain committed to killing inflation, and really the limited tools that they have are interest rates. So it's certainly not an easy time to be a central banker. But whilst their job of killing demand coming out of COVID has very clearly been done, it's not having the same effects on services, employment or housing, and leads us to believe that interest rates are going to have to go higher to have that desired effect of bringing inflation under control and sooner rather than later. But the net effect of it is, because inflation is proving to be a lot stickier, is that interest rates are going to remain higher for longer and will be cut more slowly than is expected over time. The good news is, though, that investment markets finished the 22-23 financial year strongly across most major asset classes. This was led particularly out of the international sectors and in particular a late rally in technology stocks and a lot of global enthusiasm for AI being a bit of a silver bullet for the next economic cycle, that this hopes of a narrower recovery may broaden into other sectors. But broadly, the consensus still remains that the US will enter into a shallow recession, and Europe will likely to as well, to bring inflation under control. Domestically, Australian share markets finished the year positively and remain looking reasonably strong and resilient, but they have been largely range bound for the last 12 months. And if we look at long-term valuations and PE ratios, the Australian market is really sitting at long-term fair value there, so no real cause for concerns. The fixed interest sector, though, is a whole nother story, and after a disastrous 2022, as we near the end of this hiking pathway, the risk premium on equities isn't looking as attractive as some of the yields that are on offer in this space, again, as that recovery comes through, with the potential for upside in those values that we experienced negative returns from in 2023 come through as those rate cuts and the inflation data begins to fall. Interestingly, the Australian yield curve did invert during this quarter, and that's often said that it's a precursor to a recession. We don't think that's a leading indicator at the moment, but the US certainly does remain inverted. Looking ahead, though, we still expect to see volatility in markets as they digest the impact of rate cuts and continue to guess the next steps of central banks. But that will start to slowly change as the language from central banks begins to soften. Confidence will start to creep back in, and as corporate earnings begin to stabilize, that volatility will subside and we'll start that long, slow grind out of this economic period. But look, as I said at the start, we acknowledge it is a very difficult time for people financially and for households, and no one is really immune from this. So if you are concerned about your financial position, please get in touch with us. Otherwise, stay well, and we look forward to speaking with you again shortly. Thanks very much.